Hi everyone. Today, we'll start with the practical questions on that is profit or loss prior to incorporation. Now, just to tell you what this means, I hope you have already gone through the theory. This is basically prior to the incorporation of the company. If there was any running business that was taken over by the company, then from the date when it is taken over till the time of incorporation of the company, that period is basically pre-incorporation period. So whatever profit is made during that pre-incorporation period, it is not the profit in the course of the business because that time the company is not incorporated. And therefore that profit cannot be treated as a revenue profit and it is not available for dividend distribution. And hence it has to be treated as a capital profit, so it will go to capital reserve. And that is why at the end of the first year, when company prepares the statement of profit and loss, that time company has to differentiate between the profit made during the pre-incorporation period and the profit made during the post-incorporation period. And that is what is all about included in this chapter, that is profit or loss prior to incorporation. The profit or loss made after the date of incorporation, that is the usual profit made in the course of the business, either the profit or loss, and hence that is considered as a revenue profit or revenue loss. But the question is basically before the incorporation, whatever profit or loss is made by the company, what about that? That is basically not the profit or loss made in the course of the business because that time the company is not incorporated. So if it is a capital profit, it goes to capital reserve. If it is a capital loss, it is basically considered as a goodwill. So this is what we are going to see in this chapter. So the very first question, Rama Udyog Limited was incorporated on 1st August 2011. That's the question. Just go through that. Okay. So what they're saying is basically this company was incorporated on 1st August 2011 and it acquired a running business with effect from 1st April. So that means from 1st April till 30th July or rather 31st July, that is basically the pre-incorporation period. So April, May, June and July. 4 months are basically pre-incorporation period, and after that from August onwards till the end of the year. So that is remaining 8 months. That is basically post-incorporation period. During the year 11-12, the total sales were 36 lakhs. The sales per month in the first half year were half of what they were in the latter half of the year. Net profit they have given, which the company has made during the whole year 11-12. And this net profit is after deducting all these expenses. Please ascertain pre-incorporation and post-incorporation profit for the year ended 31st March 2012. Now what we will do is basically they have straight away given the net profit. First, we will have to identify what is the gross profit because that gross profit will be distributed in sales ratio, and then the rest of the expenses will be either divided in the time ratio, sales ratio, or any other suitable basis. So, for everything, the basis of differentiation will be different, and that is why it is necessary that first we identify what is the gross profit. Now, if the net profit for the whole year is 2 lakh rupees, and these are the all other expenses which were already considered while arriving at the net profit, then how will you arrive at the gross profit? Gross profit, you will have to do the reverse working. So net profit plus all these expenses will basically give you the gross profit. So in short, I'll show you here itself. Your net profit is 2 lakh rupees. Now you will add back all these expenses to go back to the gross profit. So plus 1,23,000. Then directors fees 50,000. Preliminary expenses 12,000, office expenses 78,000, selling expenses 72,000, and interest to vendors 5,000. That means the gross profit that the company had made was 5,40,000. Now this is the gross profit. This is how you will prepare the statement for showing the pre-incorporation and post-incorporation profit or loss. So particulars. Then you will show the basis of apportionment between the two periods. First pre-incorporation period, which is in this question 1st April to 31st July. And for post-incorporation, it is 1st August. That is the date of incorporation till the end of the year. And then the total. So we arrived at the gross profit, which is 5,40,000. Now gross profit is directly related to sales. And that is why we will bifurcate this gross profit between the two periods based on the sales ratio. Now how do we calculate the sales ratio? They have said that the sales in the first half were the sales per month in the first half were half of what they were in the later half of the year. That means in the first 4 months, here, you will have to show the working note separately to arrive at the sales ratio. So that means what they are saying is, if the monthly average for the first 4 months, if we assume it as X, then the total sales for the first 4-month period, which is basically your pre-incorporation period, will be 4X. Now what will be the total sales in that case for the next remaining 8 months? They are saying basically the average monthly sales for first 6 months is basically half of the monthly sales of the latter half of the year, right? Here we have for first 4 months, we have already considered the monthly sales as X. And they are saying for first 6 months, it is going to be half. So that means for next remaining 2 months, also the sales will be X per month. So that is why for next, when you calculate the sales for next 8 months, that is basically your post-incorporation period. Out of 8 months, for first 2 months, your monthly sales is going to be X only. So that is why when you calculate the total sales for 8 months, you will have to do the calculation this way. For first 2 months, the monthly sales is X, so it will be 2X. And then what happens is, for the remaining 6 months, your sales is going to be double, because they said basically that for first half, the monthly sales are half of the monthly sales of the next period. So that means for the next month, second half of the year, the monthly sales were double. So that means for the remaining 6 months, it will be 2X per month. So what will be the total sales for next 6 months? 2X, which is the monthly sales, multiplied by 6 months, right? That will be your total sales for the next 6 months. So that means for total 8 months, your sales will be 2X plus 6 into 2X. So it will be total 14X. So that means for first 4 months, your sales was 4X. For next 8 months, it is 14X. That means what is the sales ratio? 4:14. 4:14 meaning it is same as 2:7. So this is your sales ratio. So now what you will do is basically you will first bifurcate the gross profit in sales ratio, which is 2:7. So 5,40,000 divided by 9, because the ratio is 2:7, into 2. That becomes your gross profit for the pre-incorporation. Similarly, 5,40,000 divided by 9 into 7, because 2:7 is the ratio. So that is 4,20,000. That is your gross profit for the post-incorporation. Okay, so this is how we have bifurcated the gross profit between the two periods based on the sales ratio. Now depreciation is always related to time. It is a period cost. So that is why it will be bifurcated based on time. So 4 months here and for next 8 months here. So your total depreciation is 1,23,000. So 1,23,000 for the prior pre-incorporation period, it will be divided by 12 into 4 months for pre-incorporation period. And then remaining 8 months, 82,000 post-incorporation. Okay. Directors' fees. The directors are always appointed for the company. That means the directors' fees will be only for the post-incorporation period, after the company has come into existence. So that is why the directors' fees, the basis will be actual, and it will be basically for exclusively post-incorporation period. Nothing will be in pre-incorporation period, because that time anyway there was no director. Preliminary expenses 12,000. Again, the preliminary expenses are incurred for the incorporation of the company. That is why these are related to the post-incorporation period. So it is 12,000 only in post-incorporation. Office expenses 78,000. Again, these are period costs. You will bifurcate that again in the time ratio. So 78,000 divided by 12 into 4 months for pre-incorporation. And 78,000 divided by 12 into 8 months is basically your post-incorporation. Then selling expenses. Now the name itself says it is selling expenses. So these are related to sales. So that is why we will bifurcate this based on the sales ratio, which is 2:7, which we have already calculated. So 72,000 divided by 9 into 2. 16,000 is basically your pre-incorporation, and 72,000 divided by 9 into 7, that will be your post-incorporation. Interest to vendors. Interest to vendors up to 31st is August 2011 is 5,000. That means the in return of taking over the business from that vendor, the purchase consideration must have been paid on 31st August. That is why the interest was due to the vendor till 31st August. So interest to the vendor up to 31st August is 5,000 rupees. Now how we will divide that between the two periods? Our pre-incorporation period is 1st April to 31st July, and then the interest is paid till 31st August. That means the next 1 month, that is August, basically falls in post-incorporation. So 4 months here and 1 month here. That is how you will basically divide this 5,000 rupees. So out of 5,000, 4 months, 4:1. That is your ratio. So divided by 5 into 4, 4,000 in pre-incorporation period and remaining 1,000 in post-incorporation. So that is why here also the basis will be again time, but it is time for that particular interest to vendor item. So it is 4 months of pre-incorporation period, and because it is paid only till 31st August, that means here you will not consider total 8 months. Here it is basically only 1 month which is falling in post-incorporation period. So 4:1. That's your time ratio as far as the interest expense is concerned. So all expenses done. So we'll take the totals. The total of pre-incorporation expenses is 87,000, and the total of post-incorporation period is 2,53,000. So now what will be your profit for the pre-incorporation period? 1,20,000 is your gross profit. 87,000 is your total remaining expenses. So your net profit is going to be 1,20,000 minus 87,000, 33,000. Now this 33,000, because it belongs to pre-incorporation period, it cannot be treated as a revenue profit or distributable profit. Hence, it will be transferred to capital reserve. And the profit for the post-incorporation period, that is 4,20,000 minus 2,53,000. That is 1,67,000. That is basically your revenue profit, and hence it will be part of your balance in statement of profit and loss, which will go to your reserves and surplus in the balance sheet. So this is how your net profit will be calculated. And if you see, our total net profit is 2 lakh, which is matching with the information given in the question. Net profit rupees 2 lakh. That means our working mathematically it is correct. So this is how you prepare the statement for pre-incorporation and post-incorporation. Whatever workings you are doing, you have to show the workings separately in as part of the answer only. So like how you arrived at gross profit. Net profit plus all other expenses is equal to gross profit. How did you arrive at turnover? Then when it comes to the time ratio also you have to show it separately. How did you arrive at 4:8 ratio? So that you will have to explain separately in the working.